Scott, explain to us what socially responsible investing is and where has the growth come from in this market?
Socially responsible investing is an approach to investing that incorporates and integrates extra financial data into the investment decision-making process. There's a lot of different ways that this is done, but the objectives are generally the same. That's to achieve, let's say, competitive or superior market returns while advancing the values of the institution or the investor that's behind it. Now, it's been growing at double-digit rates all across the different categories in Europe, and between 11 to 52% in terms of assets under management over the last couple years. The largest category is exclusion, or sometimes referred to as negative screening. And in that type of a strategy, the investment universe necessarily excludes investments in certain types of companies or certain types of stocks. So examples of that would be investments in tobacco companies may be excluded, or manufacturers of cluster munitions or landmines, or perhaps investment in companies that have business relationships with the Sudanese government. Now, the fastest growing category in socially responsible investing in terms of growth, but albeit from a smaller base, is in impact investing. And this is where the investor tries to improve conditions on a socioeconomic or environmental condition through the investing process. So some examples of that might be investments in housing for low-income families, or in companies that are promoting fair trade coffee in South America or Africa. Now, the growth has always been driven in terms of absolute assets under management from pension funds, institutional investors, and sovereign wealth funds. Where I work in Europe, there's legislation in a lot of countries like UK, France, Germany that requires pension funds and public investment funds to disclose how is their portfolio impacting social or environmental concerns, as well as the investment process.
Well, your clients are all institutional based, so the question of does this limit diversification or performance, it's a little bit different than a retail investor, because that would be the obvious question. There's other ways for them to improve performance, but looking at it on an absolute basis, when you employ SRI, do you lose any advantage because of less diversification or missing some of the performance of excluded stocks?
That's a very good question, and when a client is thinking about getting into responsible investing, that's like the first question that they ask. And we've looked at that consequently a lot. And there's several studies out there and a lot of work that's been done, and I haven't seen anything that indicates that you will necessarily underperform the market by excluding aspects in your investment universe, especially with the types of industries that typically get excluded in responsible investing. On the other hand, there has been some other studies out there that are promoting the idea that you will outperform the market by having responsible investing type portfolio. And I don't think the results on that are conclusive either. On the other hand, I think there's a growing consensus that companies that do integrate environmental, social, and governance type factors in their business model and their management are better managed companies and will outperform over the long run. Nevertheless, most funds and businesses are reporting results on a monthly or quarterly basis, so it depends on your investment horizon.
Okay, thanks very much, Scott, for joining us.
My pleasure.
For The Street in New York, I'm Jill Malandrino.